Joining us this morning in a CNBC exclusive on the 10-year anniversary of the IPO is Taylor Morrison Chair and CEO Sheryl Palmer, who joins us here at Post 9. It's great to have you. Congrats.
Thank you. It's so good to be here.
We were just talking off camera about some of the cycles you've seen in this decade.
Yes.
And it does bring us to the spring.
It does.
Can we give it an early report card, or is it still too early?
You know, the momentum, Carl, started building end of last year. And honestly, since we've turned the corner of 2023, we've seen that momentum, as we talked about on our Q4 earnings call, we've seen that momentum continue to build. And I think you've seen that in other builder reports lately. So there's still significant demand, and it's coming in every day.
We've talked a lot on this show about how the West is comparing to the Southeast, things like the regional disparities. Is that interesting to you right now?
You know, a little bit, but honestly, we're seeing the demand across the board. We're seeing it across all of our geographies, and we build across the country. We're seeing it across all consumer groups. You know, that first-time move-up, second move-up continues to be very, very strong. That first-time buyer, depending where, may be a little bit more friction with what's happened to interest rates. And what we call our resort lifestyle buyer, the 55-plus, once again, they're not taking mortgages for the most part, continues to be a very strong part of our business.
It's crazy because I think of housing as one of the weakest parts of the economy right now. It's where the Fed is targeting with its interest rates and trying to bring down inflation. It doesn't sound like it's doom and gloom at all from your perspective.
If you think about, you almost have to roll back to last year, Sarah, and if you think about, you know, how 2022 started, it started very strong, and it started strong because we have not, for the last many years, been able to meet the demand that's been out there. We've been underbuilding for years. In fact, I think the most favorable statistic is over the next 10 years, we need 15 million new households. So that's, you know, much better than the average we've been building for the last decade, right? So if I think about the demand, obviously then we saw interest rates move as we moved into the spring last year. And the combination of interest rates and the pricing power that we had seen for the last 2 years was absolutely too much. It wasn't sustainable. And so if I think about late spring, summer, fall last year, it was tough. But it wasn't necessarily across all consumers about absolute affordability. It was about the confidence of how they felt with that kind of movement. Nobody wants to buy at the top of the market, nor do they want to have the highest interest rate. What happened at the end of the year is interest rates settled down. We weren't seeing 50 bips of movement a day. How do you get confident in that environment, right? Once that happened, everyone kind of moved back off the sidelines. And when rates are now, let's call them low sixes, we have the ability to help the customer buy them down. And the resale market remains very tight, very tight. So new is in.
What has it meant for prices now then?
I would tell you last year prices settled back, and I think it's very different across the country. We saw some places where we saw, 10%. We saw some places we didn't move much. We've really tried to use finance as a sales tool because we can give the consumer so much more power by buying down an interest rate like 4-to-1 than just reducing the price. So it protects their equity and it gets them with the payment they can afford.